Hello and welcome to MC Explains, an investor education initiative brought to you by Moneycontrol and Invesco Mutual Fund. Usually, tax saving is a subject discussed in the last quarter of the financial year. Come January, the conversation around tax saving investments takes on a new life and dies out by the time March ends. What if I told you that there was a way to make this conversation relevant all year round rather than last minute? Equity-linked saving schemes are a type of mutual fund schemes which allow you not only to save tax but also create wealth for long term. Let me explain. First, let's understand what an equity-linked saving scheme is. In short, it is referred to as ELSS. ELSS is like any other mutual fund scheme in its construct, which means it's a portfolio of securities managed by a professional asset management company. Most ELSS schemes, as the name suggests, invest primarily in equity shares with some mix of debt and cash. Majority are actively managed by a fund manager who selects stocks and builds a diversified portfolio. By mandate, these schemes can invest across market capitalization. Under the Indian IT Act Section 80C, as per the old tax regime, any investment you make in an ELSS scheme within a financial year is eligible for tax deduction up to a limit of 1.5 lakhs. In other words, an amount of up to 1.5 lakhs invested in ELSS in a financial year is not included in your taxable income. Hence, you save on income tax to the extent of what would have been applicable on that amount which you invested in ELSS. Just like other equity funds, ELSS is a portfolio. It comes with the direct and regular option of investment, carries an annual expense or cost for investors, usually in the range of 2.25 to 2.5% a year. The unique feature that differentiates it from other equity schemes is that it comes with a 3-year lock-in. Any money invested in an ELSS will have to remain invested for at least 3 years. Thankfully, equity is a long-term asset. The longer you are invested, the greater time your equity assets have to compound returns. Now let's talk about the benefits of ELSS. One of the primary benefits of ELSS is the asset it invests in. As mentioned before, these are structured as diversified equity funds, and as an asset, equity has shown that it can deliver inflation-beating returns consistently if you remain invested for longer periods of time, 8 to 10 years and more. Then we have to look at the benefit of the lock-in period. Eligible tax-saving financial securities under the Income Tax Act Section 80C all come with a lock-in period. ELSS is no different. However, it does have the lowest lock-in of 3 years as compared to 5 to 15 years range for the others. Moreover, unlike some of the other tax-saving investments, the life of an ELSS investment continues much beyond the 3-year lock-in. You can choose to keep your money invested for as long as you desire, taking advantage of equity market compounding returns in the long term.
Tax on capital gains. Tax-saving investments do help you save income tax at the time of investment, but for most, there is a tax on the returns.
Public Provident Fund is an exception as interest paid on this is tax-free, and for unit-linked insurance plans too, there is no tax on maturity up to a certain level of investment. For all other investments eligible for a tax deduction, maturity proceeds are taxable. In case of ELSS, the first ₹1 lakh gain is not taxable at redemption. Beyond that, there is a long-term capital gains applicable at 10% of the gains made. For those who fall in the higher income tax bracket, this is more efficient than paying tax on interest earned at the same rate as your income tax. One more benefit that ELSS comes with is choice. As per AMFI, there are over 40 ELSS schemes in the mutual fund industry which you can choose from. Schemes have different fund managers and different performance patterns. You have the advantage of choice in terms of fund manager style, consistency of performance, and even choosing the asset manager you like. Then the benefit of regular investment. One of the biggest advantages of the ELSS investment is the systematic investment plan or SIP facility. As mentioned earlier, you can make tax saving investments all year round by opting for monthly SIPs. Put aside little every month rather than scrambling to collect the lump sum you need at the end of the year. Another advantage of SIP is that it automates your investment. You don't have to give a fresh mandate to invest every month. Once initiated, the monthly investment is automatically placed at a date of your choice for an amount defined by you. This makes investing a process and a habit. Transparency is one more benefit of ELSS. Mutual funds are perhaps the most transparent investment security available to you. You can look at fund fact sheets published every month for all scheme details, including the cost, the portfolio breakup, risk factors, and so on. Moreover, there is flexibility in how you invest. You can review your ELSS investment, and if in any given year you do not want to continue investing in the same scheme, you simply choose another. There is no additional cost or procedure in this shift. Information about schemes, data and details are available in public, which allow you to review your investment on your own before deciding for the next financial year. With all these benefits, it's easy to recognize that ELSS investments make for a sound long-term wealth creation tool, along with the advantage of tax saving at the time of making the investment. Thank you for tuning in, and keep watching this series for more such interesting discussions on investment solutions.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.